Hello and welcome to Sectors Up Close. I'm Ramzan Karamali. Today we're focusing on natural gas futures and my guest is Wayne Bryan, Director of European Gas Research at London Stock Exchange Group. Natural gas prices have tumbled to below the levels they were at before the war in Ukraine, but still remain far above their historical average. At the end of last August, European gas prices were at one point several times higher than they were before the start of the war. But since that peak at the end of last summer, prices have begun to fall. Russia, prior to the war, was Europe's biggest supplier. Prices are now roughly a third lower than a year ago, probably helped by a record-breaking spell of warm weather as well as its own efforts last summer to fill gas storage, including the region's largest economy, Germany, where it has been building liquefied natural gas terminals at breakneck speed. 2 new terminals have gone online there in the last 2 months alone. UK prices are also lower, as it too has benefited from recent warmer weather, trimming some demand, and has been looking to ship more LNG from the likes of the US and Qatar. Only last week, US gas prices hit a 25-month low. Those prices have since risen as output remains lower than last month, following recent extreme cold that froze oil and gas wells in several producing basins. Well, for more on where prices are going, I'm joined by Wayne Bryan from LSEG. Hi Wayne, thanks for joining us. So we've seen prices fall quite dramatically since last summer. Where do you think they're heading and what makes you feel that these are the factors that are making those head that way?
And I think firstly, when you look at the European gas market and you see where we were just after the start of the Russian invasion of Ukraine, we saw prices really start to gain a lot of that risk premium. That continued throughout the summer, and I think we know in August they reached a peak. What transpired then was firstly we had a reduction in demand. So what we've seen is that actually countries across the EU have actually adhered to the EU's demand to reduce gas consumption voluntary. So we saw so far about 17–18% reduction in demand. That includes domestic demand. A lot of people sacrifice price over comfort rather than comfort over price. So we saw that consumption fall. Industrial demand really tanked. And again, that was due to the high price environment, which curtailed production and made a lot of production, no profit was going to come from any of this production. So we saw a lot of falls there. And of course, LNG. We saw a massive ramp up of LNG imports into Europe, a lot of it coming from America. And again, what we saw here was the actual increase in COVID infections and subsequent restrictions in China crimped their demand. And that had a big impact in the amount of liquefied natural gas heading to European shores. And with European prices being so high, Europe remained the premium market. And that's continued into this year. We've had a couple of cold spells, but storages have managed. And if you look at where we are today in terms of storages, we're around 70–75% in the EU, which is above the 5-year average. And we've only got another, 7–8 weeks left before the end of the official winter season. Summer season starts in April, where we start to inject, but with these injection demands looking a lot lower, we see prices really starting to adjust lower over the coming months, and we've seen that over recent weeks.
I spoke earlier about the new terminals in Germany. What impact will the increase in supplies from the US actually have on the market?
Huge impact, and that's of course if we can attract price-sensitive buyers like India and Pakistan and Bangladesh have pulled out the market a little bit due to the high price. China, when will they come back? That's another question. But in terms of having the import capacity now, we've massively grown that import capacity, not just Germany, who will have about 6 FSRUs online by the end of the year. The likes of Holland have already negated the loss of their Russian imports by way of FSRUs and LNG import terminals boosting capacity and boosting send-out. So we expect that to continue in light of the soft demand from Asia.
The UK became the 4th country to ban the exports of Russian gas. What impact is that having here in the UK, but also the reliance on alternate sources? Will that actually have an impact in the long run?
Well, for the UK, we've got second largest import capacity after Spain in Europe. So the loss of Russian volumes hasn't really had a big impact on the UK market. And in terms of renewables, yes, that does have an impact. And renewable generation, both in the UK, which has one of the greatest potentials for wind generation globally, we probably can produce up to 40% of our needs on a daily basis through wind. Of course, it's intermittent. That's the problem. Germany, similar. They have very large installations of wind. So when it is windy and the wind does blow, we see a big drop in demand due to this increase in renewable generation.
So I mentioned earlier that US prices hit a 25-month low only last week. Do you see prices staying low in the US, and what impact will that have?
I think, yeah, the US prices typically are always a lot lower than Europe and Asia anyway. And also with the US, we've had Freeport, which is a very large LNG export terminal. It's been offline for many months now due to maintenance, and that has also fed into the bearish sentiment. Like Europe, I think the US market, everyone's quite optimistic. The spreads show you that as well. Spreads are always important to look at market sentiment. And I think if you speak to a lot of players in the market, they're quite confident for this coming 6 or 7 months. But again, this market never fails to surprise us, so there could be something around the corner. But as things stand, similar to Europe, we're in great positions now and there's a lot more optimism.
Wayne Bryan from LSEG, many thanks for your time. You're welcome. And that is your roundup of the natural gas sector. I'm Ramzan Karimali, and this is Reuters.